Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello, and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Gosh, we've got so many important things for you to listen to today to make you a smarter investor. Stay with us for the full hour here. We're going to kick off the show in just a minute here, talking about should members, you may have an opinion on this, should members of Congress be allowed to trade stocks? We have some very interesting information on that. I think you might be surprised by it. There are risks to Nvidia stock that you may not realize. We'll go over those, disclose those risks to you. And then very important, we all talk AI, but we're going to talk about understanding more about AI and why it's becoming more expensive. Yeah, we're going to talk about that. Chase, what do you got?
Yeah, I always hear the benefits, but not so much of the negatives to think through. But companies we're going to take a closer look at. We're going to look at Lululemon. I know they crashed big time last week after reporting, I'm going to say, some disappointing earnings. Also, we're going to take a closer look at Broadcom. They were on the opposite end of the spectrum. They shot up after earnings. And two other companies, PepsiCo and DocuSign. As you said, a lot of great things. Excited to take a look at those businesses. Give me an opinion if we think it's buy, sell, or hold based off the numbers we see.
You know, and we never tease with Harrison his topic because he comes on in the second half of the show and he's going to be talking about financial planning, 529 withdrawal pitfalls. So he's going to be there at the second half. So make sure you stay tuned for that.
I feel like Harrison never has good news for us.
I know, he always gives me bad news. Can I claim that? No, can't. Can I get that? No, I can't. So, but he does work for the people. So, all right, well, let's talk about understanding more about AI and why it's becoming more expensive.
Oh, you changed it up on me. I was going stock trades.
You know what? I just had the list here, so I went with that.
So we're going AI first. Okay.
Yeah, that's what that was.
Sure I got the right notes. Okay.
We have different lists, I guess. But we're no expert on artificial intelligence, and but we have learned that while AI has gotten a lot smarter, and it has also gotten more expensive. It is now broken down into a unit of AI, which is known as a token. I hate that, but that's what it is. And while the price of tokens continues to drop, the number of tokens needed to accomplish a task, well, that's increasing dramatically. So the costs are going up.
Yeah, and I want to be clear. We're not here to try and explain the technology piece to you, but trying to help you digest the financial aspect of it.
The concept of it.
The concept,
Right.
Because when you're talking about tokens, I have no idea what the hell you're talking about. It's so confusing. So, we're here kind of reading this and digesting this almost together. But this at times is almost one reason why I don't like to invest in AI because it's so complicated.
Yeah, and a token, this is just a measurement of it's just used as a tool, measurement.
It's kind of like if you're looking at energy, right? Like a megawatt of energy.
Yeah, there you go.
We'll kind of use that as a similar attribute. But speaking of AI, there are two basic attributes when we're looking at it. One is called training, and the other is AI inference. The increase in cost is coming from the training side that has to use these large models. I believe they're called the large language models many times. And it demands even more costly processing. AI applications are using so-called reasoning and new forms of AI double-check queries on their answers, which may include scanning the entire web. Sometimes they write their own programs to calculate things all before releasing an answer that may only be a short sentence. I know sometimes when I use ChatGPT or I've used Perplexity a little bit too, sometimes I'll dabble in the different ones, but you now see it's almost like, instead of the blue circle that goes round and round, it pops up with these different barons, different, Wall Street Journal. You can kind of see these icons popping up. So you can see it scanning the web, and you never really think about while it's doing it, you're just kind of waiting for the answer. But when you kind of take a step back, it's like, holy cow, that is just going through all this information that cannot be cheap.
It is amazing what goes on behind the scenes. And delivering meaningful and better responses is taking a lot more tokens. Again, that's a measurement of AI to complete that process. And looking at examples, basic chatbot Q&A requires about 50 to 500 tokens, and I use that as a measurement. Now, short document summaries can use anywhere from 200 tokens to as many as 6,000 tokens. Now, pretty big in the law field, lawyers and paralegals who use legal document analysis require 5,000 listen to this, as many as $250,000 or $200 tokens, and then 250,000 tokens of AI. And here's the amazing one. If you're trying to do multi-step agent workflows, well, now you're looking at 100,000 tokens to over 1 million tokens. And you've got to understand, when we talk tokens, we're not talking about anything that has to do with cryptocurrencies. And this is a different token pertaining to AI. It's a measurement, so you can compare what it's doing. And that's what we did. But over 1 million tokens for multi-step, that's going to be very expensive.
And I got to assume, the hope is that AI can do more and more and more. And as it does more and more and more, I'd assume the token requirement will go higher and higher and higher. Because right now, what is the, best thing to do in Italy when I travel there? And it'll spit that out, right? Well, if all of a sudden you're telling AI to hey, run this for me and send an email to this person, supposedly that's the long-term plan, right? It's almost like a digital assistant. If we get to that place, gosh, it's going to have to be using a lot of tokens.
And the thing too, it may not be worthwhile because somebody has to pay for it.
Yeah.
And if it's beneficial for the company, but if I got to spend too much money on it and the consumer says, well, I'm not paying that much, it's going to have some problems. So you got to understand what you're paying for AI, and you got to use the tokens.
Speaking of spending, there's some big companies that we know about out there. They're spending $100 billion or more to create the cutting-edge AI models and building out their infrastructure. However, for all that investment, there needs to be a return on investment. And businesses and individuals, kind of as you were saying, will eventually have to pay more for artificial intelligence. The CFO of OpenAI said last October that 75% of the company's revenue comes from your average person paying $20 a month. I was kind of surprised by that. I know you talk about enterprise AI and kind of pushing into the businesses and so forth. So I was surprised the average person paying $20 a month is what's occupying the revenue. The other thing, I personally don't know a single person that pays for AI right now. I use all the free ones.
Yeah.
So I don't understand what the difference is necessarily between the base model and the higher end ones. Kind of speaking to that point, the cheapest AI models, which includes OpenAI's new ChatGPT 5 Nano, is costing around 10 cents per million tokens. But go to the top of the line GPT-5, and that costs about $3.44 per million tokens. Again, I'm not sure what the difference is, and maybe it'd be worthwhile to test out the free service versus the $20 a month service to actually get an idea of it. But I don't understand the point of paying for it at this point.
And again, when I look at what can happen in the future, and again, I think you mentioned $20 a month was what they're starting.
Yeah, $20 a month is what it looks like. I don't know if that was last year, or if that's the current price as well.
And I know most people, including myself and yourself, we use the free service. But is there a point where that will go away and they're going to force you to do the 20? And then as a consumer, you have to say, okay, well, what's it worth to me? Is it worth 20? Or if they raise it to 40, 50, $100 a month, would you then say, no, it's not worth it?
Yeah.
I don't need that much information that quickly.
Yeah. That's the big question. Like I said, that's one of the big questions. But the other big question, and I'm going to say concern, is how long the big tech giants can keep up this spending when they're competing with their own customers. You talk about Microsoft and OpenAI, I'm going to say is the prime example, right? They're kind of in this love-hate relationship where they're competing against one another, but also kind of using each other's products. It's going to be very interesting to see how that all changes over time. And my big concern with this is right now, again, I talk about Perplexity, you talk about OpenAI, you talk about Anthropic, you talk about Grok. I don't think, I left out Google, right?
Yeah,
Gemini.
That's when I use Gemini all the time.
That's 5 right there. I don't think you're going to have 5 successful chatbots 10 years from now. Again, you look at Google, Bing, Ask Jeeves is one I joked about from earlier. Right? I remember that from my childhood, and obviously that disappeared. But this is what makes me so nervous about investing in these AI companies is we don't know who the winner is going to be. It's so overly complicated, and I don't think there's enough demand out there long term to be able to satisfy that for 5 major players. And again, you talk about maybe, well, now we got to charge $40 to make a profit. Well, right now I can go from OpenAI to Perplexity, and they're maybe only going to charge me 10. So there's all this competition, and that's not going to make it profitable.
And I'm just thinking out loud here real quick. Microsoft kind of lost the race on search to Google, and their stock languished for many years. Yeah. Right now, they seem to be the leader in AI. What if they lose that race as well? That could be a major problem for Microsoft.
Yeah.
A lot of competition.
I mean, I don't know. I would almost say, obviously, that OpenAI is kind of the leader in this space. But yeah, how much is Microsoft benefiting from this relationship with the OpenAI? That's just been a confusing relationship to me. And there's just so much. Again, you talk about the tokens, you talk about all these chatbots, you talk about just AI in general. It's a very complicated, confusing space at this point in time.
And
It's exciting.
It's very exciting. Companies are spending billions of dollars, but there's got to be that return on investment. And if not, they may say, hey, we're going to pull back on spending all this money on AI because we can't get a return on investment.
Yeah.
So, all right. Do you now want to talk about members of Congress on stocks?
Yeah, we can talk about that.
Okay. So let's talk about, should members of Congress be allowed to trade stocks? I recently saw there was a bipartisan bill presented in the House that would ban lawmakers from trading individual stocks. I feel like we have been hearing about this for years, actually many years, and according to NPR, for more than a decade, a series of bills have been proposed to address such trades, but differences about the details and lack of support from top congressional leaders stalled past reform efforts. And the question is, I'm going to ask it, will this time be different?
And I love the part in this quote excerpt from NPR. Lack of support from top congressional leaders. I wonder why.
I know. Well, we
wait a
like
minute.
trading, especially when we give some of the data why they love trading. Yeah.
But I mean, when I saw this, the bill made me curious about how active Congress was when it came to trading. And let's just say, I mean, I couldn't believe the numbers. In 2022, 154 members of Congress made 14,752 trades. 2023, 118 members, 11,491 trades. In 2024, 113 members made 9,261 trades. I'll say a light year for Congress in 2024.
Right.
And through July of 2025, 108 members made 7,810 trades. I mean, this is just a crazy amount of activity, and I'm not sure how they even have time for that. Aren't they supposed to be taking care of their constituents, not worried about trading stocks back and forth on a moment-to-moment basis? Because, I mean, you're talking about, on average, 3, 4, maybe 5 trades. That would give you, just make it easy, 100 members, about 400 trades. We're talking about 10,000 essentially on average. I mean,
you're talking hundreds,
nuts.
thousands of trades. And next time I look when they show Congress on TV, I'm going to look to see if they're on their cell phones during trades. I would hope not. I hope they're paying attention.
I mean, I'm just thinking about this right now. Just make numbers easy again. 100 members of Congress, 10,000 trades. That's 100 trades essentially per Congress member.
Right. I'm having dinner with a congressman tonight. I might kind of pose that question to him. I don't want to offend him, but like, hey, can you tell me what's going on with this?
It's odd to say the least, and you know, I mean, we'll have a further discussion. But gosh, it doesn't make sense to me.
Well, you talked about the numbers. Let's talk about the return numbers, because the returns, well, a lot of people would love to have these returns. Democrats producing an average return in 2024, 31.1%. Republicans, they produced an average return of 26.1%. Now, comparing to the S&P 500, that was up 23.3%. Now, the numbers, they're very staggering when you look at the individual performance of some of these politicians. And this really got me when I saw this. In 2024, Rep. David Rouser, I believe I will say his name, is a Republican from North Carolina. He made 149%. You're laughing. It's crazy. I mean, we should hire him as our money manager.
That's what I'm saying. Yeah.
Representative Debbie Wasserman Schultz, she's a Democrat from Florida. She was up 142.3%. Senator Ron Wyden, a Democrat from Oregon, 123.8%. Again, it's not just a few here. Rep. Roger Williams, a Republican from Texas, up 111.2%. And this one surprised me. Nancy Pelosi, who's been accused of this the most, well, poor her, she was only up 70.9%. I guess she took the last year off or something after all the flack she took.
She didn't get the hot tips, maybe. I don't know. I mean, the thing you look at, these are hedge fund beating returns. I mean, if we told our clients last year you were up 110%, 140%, I mean, I think we'd be managing tens of billions, hundreds of billions of dollars. I mean, these are just staggering when you look at it. And personally, I think it's ridiculous that politicians can trade individual stocks, and I do hope there's finally action that ends this. And, you know, I kind of look at it, you know, one of our employees, her son works at one of the big accounting firms.
Yeah.
He can't hold individual stocks.
No.
I think the politicians know more about companies than he does. It's crazy that that limitation's not placed
And we
on
have
them.
clients come through that they say, I can't manage a portfolio, can you do it for me? We do have discretion, so we can do that for people that can't do it themselves. But why isn't Congress have the same restrictions? Now, I know that some of these congressmen, they have large businesses, they might have a big stock portfolio. That's fine. Let somebody else manage it, put it in a mutual fund, do something else with it. And not even mutual fund because they might pay taxes, but give it to a professional money manager to do it. You should not be doing it. And what even gets me is now we're hearing more about the cryptos. And unfortunately, we're going to bring this out. Our president is very much into cryptos, and he's done some things that we don't agree with that either. It's just everybody's kind of taking advantage of their situation.
Yeah, and this is where we disagree. I don't think you should be allowed to have a money manager. I think, you're getting in Congress to be a public servant.
Right.
And if it means you paying taxes, well, you're going to have to pay taxes on those stocks at some point anyways. I think you should have one of two options. You either liquidate your portfolio, go into Congress at that point, you can buy index funds, or you put a stop on that portfolio the day you enter Congress. So you can go in. If you don't want to sell the stock because you're worried about taxes, fine. But that means you now have to hold that stock until you exit Congress.
I think a blind trust something because
I just don't trust people.
Well, but you could have $100 million portfolio. It's unfair to say, well, you can't sell anything, or you got to sell it and pay all the tax. I mean, there is alternatives to that. I think a blind trust where they don't know what's going on. But again, they have no contact with that money manager. They can't. Now I know that's probably what you're afraid of. There is some pressure. Like, you're going to do this, I'll move it from.
Let me ask you this: do you trust politicians?
Oh, most definitely. They're the most.
That's what I
honest.
mean. I just think you start to kind of make these concessions, they'll find loopholes, and that's just where I think there needs to be change, and maybe starting with the blind trust is a good kind of way to go about it. But I'm pretty confident. All of a sudden we find out, oh, Nancy Pelosi's blind trust was up 80% last year. It's like, how blind was it really?
Well, yeah. I mean, or maybe, well, again, the tax comes into it. Well, I think people get the message on that one. So let's move on because we don't waste too much time here. Not waste, but spend too much time on this. But the risk to Nvidia stock that you may not realize. You may love the stock, and yes, it has done extremely well. That returns are very impressive. But one major problem with the company that we discovered is the revenue is extremely concentrated. This is something we've looked at for years in our companies. We don't like companies that have just a couple of top revenue producers. Their top customer, listen to this, made up 23%, almost a quarter of the total revenue in the most recent quarter. And what's even worse, last year was only 14%. So that could be getting even worse going forward.
It's getting more and more concentrated. Yeah. And I mean, same thing with the second largest customer. They made up 16% of total revenue, which was up from 11% in the same quarter last year. And then if you look at sales to four other customers, they contributed 14%, 11%, 11%, and 10% of revenue respectively. This means that 6 customers accounted for approximately 85% of NVIDIA's total sales. My concern is, what if one of them drops out of the AI arms race, or if a few of them pull back spending? That could really slow NVIDIA's business. We kind of had this conversation already, but again, it's like, I don't think there's going to be 4, 5, 6 major players in this space where you're investing all this money. I think the return on investment for a few of these players is going to be bad.
Yeah.
Years from now, they're going to be like, man, we wasted $100 billion. That was not a good decision.
We'll go back to $50 billion. And what we're pointing out is we're not saying, oh, gosh, NVIDIA's going to crash tomorrow. We're pointing out to you the risk that you have. And there's a risk to reward, and the risk with NVIDIA is getting higher. And then I'm going to bring up another point, too. I'm going to talk about China, because we believe that China is a risk to NVIDIA as well. I mean, while sales have been hindered in the country due to political constraints, I believe many investors are looking to China as an area of potential growth for the company. Well, think about this. All I can say is that, do you really think the Chinese government wants Chinese companies use an American company called Nvidia? Can I say hell no on radio? I think I can.
I mean, I think, it's kind of like here, it's we don't allow Huawei into the U.S., and I'm even surprised China allows NVIDIA in. The only thing I can think of is they want to maybe steal some of the technology.
For now, they need it.
Skeptical, but
they need it.
They need it, yeah. But I know I've seen people say, well, actually, NVIDIA didn't have any sales last quarter, and they didn't guide for any sales in China this month. They're kind of saying, like, that's not baked in. But I think a lot of people are hopeful that there will be sales in China. So even though they're not guiding for it, I think there is that hope that the sales will come through in China. So Nvidia might be saying, oh, no, we're not counting on it. But I think a lot of analysts and investors are.
Yeah, and that's, again, we're just disclosing the risk to you. I mean, Nvidia could go to 200. It could go to 100. You just don't know what's going to happen. And whenever you invest, you have to understand the risk you're taking. And there's a lot of risks that I don't think people knew about this. They just thought, oh, Nvidia is great. It's got all these chips. Nobody wants them. But the concentration, I mean, can you imagine our portfolio if we just had 6 customers?
Oh, it'd be scary. You lose one, it's like, oh, man. And I mean, with the China risk, too, I mean, you look at the companies there. Alibaba actually recently developed an advanced chip. And then I got to assume they're not the only ones working on it. There's got to be Huawei. I know, like, Xiaomi is like a big tech company now there. They're working on cars and other things. I just have to assume China is wanting their top tech companies to be investing in this space. And I'm just very concerned about NVIDIA's valuations with the risk that is coming from these high concentrated customers. And I'm still going to say the hope that there will be Chinese sales.
Well, if you like this information, it all comes from our newsletter that goes out every Friday at 5 o'clock by email. Other topics on there: should you buy the new iPhone or work with what you have now? Here's another indicator showing how overpriced the S&P 500 is. Does the BLS, which is Bureau of Labor Statistics, need to change the way they calculate the job numbers? And inflation report likely cements Fed rate cut coming out on Wednesday. So that's all free on the newsletter. Go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. So should we do a company now? Analyze a company here, break it down?
Let's get into it.
I've got Lululemon up first. Is that where we're going?
That's what I got.
Yeah. Well, they had some great news. I'll let you give the news. I'll start with the numbers here.
Great news, bad news.
Well, great news that was bad.
Headline news.
Headline news is what I meant. Yeah, not great news, but headline news. Lululemon, their symbol is Lulu, L-U-L-U. They are in the apparel retail industry. 8% short on the float. It's not high, but it's getting there. Wow. The PE ratio, 10.9 versus 24.8. I remember this PE ratio used to be one of these high flyers at 25, 30. Here's another example of a high flyer. Now 10.9 is the PE ratio in the last 12 months. Price of sales looks good, 1.8 versus 2.2. Price of book value, 4.3 versus 6.8. And then price of cash flow, 10.1 versus 17.3. Valuation ratios, you want them low for the company. That's what we have here with Lululemon. That's a good thing. Now, another good thing is the PEG ratio, which is your price earnings divided by growth. It's only 2.9. That's another good number there. Now, they're not doing bad. It's just that the hype, I think, is gone from this company. Their earnings over the last year were up 13.3% above the industry at 4.1. Sales climbed by 9.2, also higher than the industry at 5.5. The 5-year earnings per share growth rate from the analysts is 4.2%. Industry down 64%. So again, these are decent numbers, not phenomenal numbers, but they're decent numbers now. Lululemon does not pay a dividend. Taking a look at the balance sheet, current ratio, very nice, 2.3 versus 1.7, shows some good liquidity. And they don't have a problem with the balance sheet. Debt to equity, 0.4 versus 0.9. Net profit margin, wow, double the industry at 16.4 versus 8.8. And then return on equity, very good, 40.7 versus 34. And free cash flow is about $1.2 billion, not as good as the industry at $3.2 billion. Chase, what do you got going forward?
There's a current price here for Lululemon. Again, their ticker symbol, easy Lulu, L-U-L-U, $159.87. 52-week range, the low $159.75. It actually did hit that on Friday, and the high here, $423.32. This stock has just been decimated this year. I was blown away by this. I knew they weren't doing well. I didn't realize they were down 57% this year alone. Yeah. And I did look up the all-time high. It came in December 2023. It hit $516.39. Ooh,
somebody bought that price.
Yeah, that's unfortunate. And you look at the 5-year return, I mean, it's down 49%. The 10-year return still up 213%. So as you said, it got wrapped up into this hype of leggings and everybody wanting the leggings. And I think competition kind of
you can only have so many different designs. That's part of the problem, maybe.
Yeah, I mean, I got some information here, but I'll give you the target sell price first because I mean, it is actually starting to look quite intriguing. I mean, you go out to January 2027, estimated earnings per share here, $13.26. It gives you a target sell price of $220.12. Its forward PE is now under 12.5 times. I remember for years this thing was like 30, 40 times earnings. But I mean, what led to the big fall was just a huge miss in guidance. Lululemon said they're now expecting full fiscal year earnings of $12.77 to $12.97. Wall Street was looking for $14.45, and revenue also was a miss, as they're expecting $10.85 billion to $11 billion, and Wall Street was looking for $11.18 billion. They are getting hit pretty hard on the tariffs as well. Yeah. They said the de minimis actually is having quite an impact on them.
That's in the newsletter. More about it, get the newsletter. And I did notice, too, that their earnings, that the range is not very tight. We like a tight range. There's 26 analysts. The lowest been 11, the high 1671. That tells me that they're really not convinced on this yet. And they have fallen a lot of the last 90 days. They were 1589, and I think you said now they're about 1381. So they have fallen. So I do question how many special outfits can you sell.
Yeah.
And they have a lot of competition. I mean, you've got Aerie, you've got, I can't even think of the.
You have Vori, you have Alo. I mean, you have Nike. I mean, you have the legacy players in there too. And the thing I'm worried about, if you look at the conference call, the CEO, McDonald, said on Thursday that he believes the company has let its product life cycles run too long, particularly in its lounge and social categories, where, again, they became popular and famous. We have become too predictable within our casual offerings and missed opportunities to create new trends. To regain its U.S. momentum, McDonald's said the company plans to increase its new styles from 23% of its overall assortment to 35% next spring and improve its fast-track design capabilities. He said Lululemon will not make any short-term decisions that could hurt or damage the brand in the long term, but my concern is you're going to be introducing all this new product, right?
Right.
There is a lot of risk in that. And this is one thing that always scares me with retail.
Well, fashion retail.
Fashion retail.
Right.
You miss on that new offering. Now, not only did you essentially lose out on sales of that new offering because nobody wants it, but it drives up your costs. Yeah. Because now that product, I mean, again, 35% of that next spring is sitting as inventory on your books. It's sitting in your stores. It's costing you money. I worry that they're like, we know what we're doing. We were so successful. We're just going to replicate that with a new, different trend, and that trend doesn't stick. I think maybe they overstep and have a false sense of confidence, and I worry that could lead to a downfall and some issues for Lululemon.
Yeah, it's hot yesterday, may not be hot today and tomorrow, and it's very hard to predict what the consumer wants. So worth watching maybe, but you got to understand the risk there. So, all right, we'll take a quick break here. When we come back, we got Harrison Johnson coming up. He's going to be talking about what I say it
529
was.
plans.
529 plans. Thank you. Stay with us. We'll be right back. You're also Smart Investing Show with Brent and Chase Wilsey. All righty. Welcome back to the second half of the Smart Investing Show. We still got some companies to go over, Broadcom, Pepsi, and DocuSign. But right now it's time to talk about financial planning. For that, we turn to our financial planning expert, Harrison Johnson, CFP. Harrison, thanks for being on the show today.
Yeah, thanks for being here. I heard you guys say earlier that I never have any good news. So
yeah, I don't think you have good news today.
I didn't
either.
think you heard that. Well, today you're talking about 529 withdrawal plans. So is this good news? Or pitfalls? I'm sorry, pitfalls.
It's something to be aware of. And, you know, a lot of people have some knowledge of how things work, and I just try to add context to that. But with the 529 plan, so it's an education plan. A lot of people associate it with college funding. You put money into it after tax, and then it grows tax deferred. And then if you make withdrawals for education, qualified withdrawals, those withdrawals are tax free. So it's kind of like a Roth IRA for college. So the thing I wanted to point out here is, number one, if you make a withdrawal that is not for college, the earnings component of that is subject to taxes and penalties. So if you're in California, you have federal taxes, you have California taxes. Also, you have a 10% federal penalty and a 2.5% state penalty. So that's just on the earnings portion, though. So if you put money in, only the growth, if you withdraw that, has taxes and penalties on it. But the main thing I wanted to talk about is The tax bill that passed a couple months ago, it had in there some provisions that increased what you could take qualified education withdrawals for. So it's predominantly for college, tuition, room and board, supplies, books, things like that. You can also use it for K through 12 expenses. And before this amendment to the tax law, it was only for tuition through K through 12. Now you can use it for tuition for K through 12 plus supplies and books and other things like that. But the thing about it is 529 plans and this tax bill was all federal. So in the state of California, the state does not recognize any qualified K through 12 expenses. So tuition, supplies, anything that you take K through 12, the earnings component of that is subject to California state income taxes, and it has the California state 2.5% penalty on it.
It's basically like most people are 9.3, so I mean you're at about 12 would be the penalty in taxes for the average person.
Yeah, on the earnings component.
And it's probably just a shocker. Like, you think you're trying to do all the right things. And I know you've talked in the past about 529 plans. Should people do them? Should they not do them? I've talked in the past, too, about a lot of people I don't think should go to college. Not everybody needs to go to college. And then you get these plans you're kind of stuck with. It's important to know what happens if you say, well, my son or daughter didn't go to college. I got this 529 plan. You're going to be hit, I'll say, fairly hard with the penalties in the state and federal.
Many times you'd probably be better off just paying capital gains rates along the way.
Yeah, especially if you're in the 0% capital gain rate. Because with the 529 plan, the benefit is the tax-free growth. You don't get any benefit for contributions. It's only the growth portion, which means to get the most tax-free benefit out of it, you have to put money into it as early as possible and as much as possible, so there's more time for compounding and growth. But that means, if you have a young child that you're trying to fund through, if you use anything K through 12, you're going to have extra taxes and penalties on it. So that means college is really where you get the everything tax-free, but that means you might be making contributions for somebody who's young and they're not going to be in college for, 15 years. Who knows what college is going to look like in 15 years?
Yeah. And will your son or daughter go to college? I mean, and these are things when people come in for a financial plan. You go over this, you explain the differences. Should they do a 529 plan? Should they not do? I mean, I know when I was younger and had my kids, I said I'm not going to do a 529 plan. Or then it was called what they called UPMA, CUTMA accounts. I think
those are custodial accounts, very similar. There's also like educational IRAs or Coverdell accounts.
Coverdell, there was a few of them. But I never did them. I thought, no, I'm going to build my own wealth, because what if my kids decide not to go to college? Well, they don't turn out so good. Chase turned out pretty good, so. It's only the other three. I don't want to.
They all suck. No.
Fortunately, there is another provision with 529 plans where if you have money left over and you don't need it for education or anything, up to $35,000 can be withdrawn and then used to contribute to Roth IRAs for the beneficiary of that. So there is that slight, backdoor out of it.
Let's repeat that one again. I missed that one.
So $35,000, if you have in a 529 plan, you're able to make withdrawals from that, essentially qualified withdrawals, if you use that money to make a contribution to a Roth IRA for the beneficiary.
That's a nice thing.
So it's not a rollover. It's not like $35,000 goes straight across. You take the annual limit, $7,000 a year, you withdraw that, and then you can use that to fund a Roth IRA for the beneficiary. So it's something else that you can do without being subject to the tax and penalties. But it's only $35,000. That's the lifetime limit you can do.
Does that allow California the same thing? Or
yeah.
Okay. So, that's nice. California finally did something nice for people. Wow. It's so important when you look at all these different things, and people, I've always say this, I won't go too deep into it. When you go to a financial plan, they're trying to sell you mutual funds or do mutual funds or manage your money. There's so many things are missing, because every week you come up with something different. And like the $35,000 going from the 529 to a Roth, I bet you many financial planners don't even know that.
A lot don't even know it. So, I mean, it's nice that provision is in there, because it gives you an escape, because we have people that, have funded 529. I talked to somebody a day or two ago that has $400,000 in a 529 and she's out of college. And so she's like, what do I do with this? And it's like, I mean, you can change the beneficiary to somebody else. She has a son, so she's going to think about doing that. But, you want to know how all of these things work. That's why, I try to add context, because people think, 529 is used for education. Well, be aware of all the rules and stipulations on, what funding that account means long term.
I mean, I'll tell you, you mentioned you didn't do it. Obviously, my 2 daughters, I'm not starting a 529 for them. I just think I'd rather, if I was going to invest for them, as I said, invest in a brokerage account, or kind of just, I like to have control too, because at the end of 18 years, as you said, it's like, well, what if I don't think my daughters are ready for getting $50,000? In an UPMA account, you got to give it to them. Mm-hmm. In a 529 plan, if you don't give it to them, well, then you got to pay all the penalties and taxes on it. So, you might give up some tax benefit, but I think the 529, the benefits are so limited, I don't think it's worth the risk.
Well, especially a lot of people think about college when their kids are like 15, 16. And at that point, it doesn't matter. There's no room for growth, so the tax-free benefit isn't there. So, 529 plans only make sense if you fund it early, but now you don't really know what those dollars are going to be going toward, and you're subject to all those limits.
And I know you got to run real quick here. Do you think most people do it because, it's tax-free?
Yeah, that's absolutely why they do it.
They don't think ahead 15 years, like as Chase mentioned, other factors, just as they're tax-free. So that's, again, why they need a good financial planner. Harrison, thank you very much. We appreciate it.
Thanks, guys.
Again, that's Harrison Johnson. He is a CFP, financial planner at Wilsey Asset Management. If you want to contact him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. You can send him an email and say, hey, got some questions for you. You do get a free consultation with him. So take advantage of that and compare it to your current financial planner. I think you'll find a lot of differences. All right. We're doing Broadcom, we said?
Broadcom, yep.
Yeah, Broadcom. And we talked, when we picked this one for today, I said the symbol, AVGO. And do you remember where that came? We probably don't. I'm probably putting you on the spot here.
Yeah, you did. I'll have that answer for you by the time it comes to me.
Let me get into it a little bit. Again, Broadcom, symbol AVGO in the semiconductor industry. Not much short on that, 1%, 80% institutional owned. PE ratio, 91.9 versus 57.2. I know the stock has had a big run up here. Price to sales, 29.1 versus 13.4. Price to book value, 23 versus 11.5. And then we do see price to cash flow, 68.6 versus 36.3. PEG ratio, about the only thing that I can say looks halfway decent at 4.6 versus 16.8 for the industry. But very expensive right now is Broadcom. Let's see what they're doing. Their earnings, well, they were up 121% over last year, about 3 times the industry at 47%. We do see sales climb by 21.9%, not as good as the industry growth. It's 64.3. They do have a 5-year estimated growth in the analysts of 11.1, industry at 28.5. So again, kind of question that high valuation it's getting. Could be that's just kind of happened, so everybody's excited about it, pushing it up. They only pay a 0.7% dividend, and I'm looking close at that because it says it's 81.3% of their earnings. The payout ratio, 81.3%. That means they don't have much in earnings. That's kind of strange.
It's got to be write-offs or something.
Something there, yeah, because that's not a good payout ratio. We do see that on the balance sheet. Current ratio 1.1 versus 3.2. Debt to equity is 1 versus 0.3. And a net profit margin 22.6 versus 23.6. Return on equity 18.6, well below the industry at 58.5. And cash flow 22.6 billion, industry at 43 billion. Chase, what do you got going forward?
Yeah, so go back to your initial question there for Broadcom, their ticker symbol AVGO. The reason for that is in 2016, the company Avago Technologies acquired the original Broadcom. They kept the Broadcom name, but then they also they changed to Broadcom, but they kept the AVGO ticker symbol like the original Avago company.
I wonder why they would do that. It's kind of strange.
Yeah, I'm not sure either. Yeah, I mean, it's like you're changing the name, so why not change the symbol? And I was kind of surprised when you're going through some stuff. I was thinking about Broadcom, and I will say one thing that they've done a great job of, so far at least, is integrating different companies. Because, I talked about that 2016 acquisition. That was, I think it was like in January 2016, Avago Technologies acquired Broadcom for $37 billion. That kind of kickstarted things. In 2018, they acquired California Technologies for $18.9 billion. Then Symantec's enterprise security business in 2019 for $10.7 billion. Then they also acquired this company Brocade in 2016 for $5.9 billion, and then the big one was VMware in 2023 for $69 billion. I mean, a lot of times companies, when they're doing acquisitions to this scale, it's very hard to integrate, and a lot of times it leads to, I think, more difficulties. But I give them credit, I guess, so far that they've been able to integrate them pretty well and have a successful business. But looking at the numbers here for Broadcom, ticker symbol again, AVGO, $359.87, 52-week range. I mean, this thing has just been dominant. 52-week low, $138.10 in the high, $374.23. We go out to October 2026. I see estimated earnings.
Wait. Did you give the 10-year return? Did you see the 10-year?
No, I did not get the 10-year. What is it?
3,515%. I just couldn't let that slide. I'm sorry.
Yeah, I think it's not quite Nvidia status, but obviously it's up there. But looking at the, again, forward basis, so go out to October 2026, estimated earnings per share $9.18, gives you a target sell price of $152.39. Obviously below that current level, and it trades at, about 40 times those future earnings. And the company reported earnings last week, and the excitement wasn't necessarily around the outcome of the earnings and the sales or the guidance, but the excitement came around the fact that they said on the earnings call it secured a new $10 billion customer, and analysts are believing that is going to be OpenAI.
And now, didn't I see that there's a little bit of competition maybe for Nvidia, for what they're kind of saying on Broadcom?
Yeah, I mean, this is kind of where Broadcom...
Oracle had a big news, too.
I figured we might look at Oracle next week just because it was so crazy. I mean, Larry Ellison gained like $100 billion in net worth in one day. But, I mean, Broadcom's interesting because, you have CPUs, GPUs, and Broadcom has this thing that they call XPUs, which is custom artificial intelligence chips. And what people are maybe speculating here is that OpenAI and Broadcom are co-designing a chip that will hit the market next year. So rather than buying Nvidia chips, is OpenAI working with Broadcom to create their own? And supposedly Broadcom has other customers for their XPUs, which includes Google, Meta, and then TikTok parent ByteDance.
Which one? ByteDance?
ByteDance.
Oh, wow.
Which owns TikTok.
TikTok, yeah.
So, it's an interesting thing is, will Broadcom be taking market share from Nvidia? I mean, I don't, again, understand enough about this chip making space. I don't know what the heck an XPU is versus a GPU. But gosh, I mean, it seems like obviously people want to be in this space because you got, again, Microsoft, Meta, Google spending the $100 billion that we talked about. Broadcom's probably saying, well, we want some of that. We don't want it all to go to Nvidia.
Yeah.
So, I mean, I don't know. I think there is some potential merit for Broadcom to see growth in their earnings and growth in sales, but it's high risk, obviously, trading at 40 times those future earnings.
Yeah, and we kind of talked about Nvidia in the first half of the show about the competition. I mean, here's a good example of what's Broadcom doing? What is Oracle doing? I mean, everybody's trying to get part of that. So, as we said, there'll be probably one or two winners, but there's a lot of competition there. And just because it reminds you so much of the .com, if you had .com behind any company, it would go up. Right now, if they do anything with AI, it's going to go up dramatically. And some of these will be winners, but you just don't know which ones.
Oh, and there's different levels, right? Like we talked earlier in the show about, they call them the hyperscalers, or, you talk the chatbots. I mean, basically you have your chatbots. Then you have your hyperscalers, which are kind of providing these data centers. Yep. And then you have the chip companies that are providing chips for the data centers. I mean, there's going to be winners at each level. But again, as we kind of said, it's just so hard to pick the right winners this early in the game.
And this is like if you invest in them, hopefully you hit the home run. But there's a lot of risk in here. And you might, good example was Lululemon. We talked earlier in the show. It was up to $500 now. So $150 or something. Because that excitement went away.
And the business, as you said, is not a bad business anymore. Yeah. It's just not as exciting as it once was. And that's what people miss a lot of times. It's like, well, Broadcom's not going to go away. It's like, that's correct. But if it gets less exciting, that's where you can have a Lululemon type event where it falls 50%.
And you just said something that I try to tell investors, don't say stuff like that. Whereas you said, they say, oh, it won't go away.
Yeah.
It won't go away, but the valuation can change and the game can change. And that's what you have to understand with investing. That's why we don't buy these high flyers. And we always say, congratulations, you bought Nvidia 10 years ago, congratulations. But that's the exception, not the rule. We like to invest in companies that we know what we're paying for and what we're getting for that company. With that, shall we switch to Pepsi? Nice, easy.
Oh, that's not
company.
AI.
That's not AI at all. I bet you they use AI for something, though.
Probably.
So let's talk about Pepsi. Their symbol is PEP. They're in the beverage non-alcoholic industry. And I know they have food as well, but they're in the non-alcoholic beverage industry. Only 1.6% shares on the float side. On the short side, no problem there. 79% institutional owned. PE ratio, 26.1 versus 25.8. We do see a price of sales 2.2 versus 2.8. Price to book value 10.7 versus 5.8. Price to cash flow 16.2. That is better than the industry at 23.6. And you have a PEG ratio going forward of 5.2. That's about 1/4 the industry at 20.1. Now, the earnings for Pepsi, unfortunately, were down 20.3% over the past year. The industry was down 17.5%. Sales for Pepsi down 0.3%. But the industry, and again, non-alcoholic beverages, was down 11.5%. 5-year growth rate for Pepsi, the analysts say 3.3%, not as good as the industry, growth of 5.8%. You get I'm going to say a good dividend from Pepsi. It's 4%. Now, it does show they use 99.8% of their earnings to pay that out. I think as their earnings have dropped a lot. But again, that dividend, I'm going to guess at this point we don't see it being cut. But still a nice dividend of 4%. The balance sheet, you got a current ratio of 0.8 versus 1.4. Not great, but not terrible. Debt to equity is high, 2.8 versus 1.5. Net profit margin for Pepsi, 8.2%, below the industry at 11%. And return on equity is 41 versus 37.5. And here's an important about the dividend. Free cash flow is $7 billion. The industry is at $1.8 billion. So I'm going to say based off of that and some of the things I saw, I'm not concerned about the dividend being cut anytime soon. Chase, you got some news. What else you got there?
Yeah, we'll start with the current price here for PepsiCo. Again, their ticker symbol PEP, $143.53. 52-week range, the low here, $127.60. The high, $179.43. Looking at the last 5 years, I mean, the stock hasn't moved much. It's up about 5%. I mean, you've probably gotten that decent dividend of, we'll call it around 4% over that time frame, but again, not very exciting returns. 10-year return about 55%. So, I mean, you've probably done decent over the last 10 years with the dividend, but again, not setting the world on fire. Going forward for PepsiCo, though, I was a little bit disappointed by this because I was intrigued by the story. I know the stock has kind of languished somewhat, as I said, over the last 5 years, but I still go out to December 2026. Estimated earnings per share here, $8.50, gives us a target sell price of $141.10. Still trading at nearly 17 times those future earnings.
You know, and I'm kind of looking at it as well. And those earnings are pretty tight there. Low estimates 822, the highs 870. But again, I haven't read Pepsi, but other ones I read when I'm looking at other companies, GLP-1s, diet drugs keeps coming up. Pepsi has chips, I think, Fritos, but they do have an active manager coming in. Was Elliott Management, I think, is trying to do some things here.
Yeah, so Elliott, they actually took a $4 billion stake in PepsiCo,
Ooh.
which that is reportedly the hedge fund's largest equity position ever. Wow. And makes it one of PepsiCo's top 5 active investors, excluding those index funds. And it's kind of interesting to read what Elliott said. They said, while unfortunate, this disappointing trajectory has created a historic opportunity with the right mindset and appropriately ambitious turnaround plan. PepsiCo today represents a rare chance to revitalize a leading global enterprise and unlock significant shareholder value. It says despite its strengths, PepsiCo North America has underperformed its peers for more than a decade on both growth and margins. This long-term underperformance stems from several related strategic missteps, including self-inflicted share loss in soda, an underperforming vertically integrated bottling structure, and a proliferation of new brands and SKUs that has strained focus and execution. And what I wanted to emphasize on here is this brand is very complicated. I mean, you have stuff all over the place, right? You know about soda, but then they have chips where they have the Santina's chips. They have, which is like the Mexican chips. They have Tostitos. They have Sun Chips. They have, there's so many brands here. It's hard to scroll through, honestly. They have Muscle Milk. I mean, they have
Muscle Milk. I drink Muscle Milk.
Mountain Dew, Ocean Spray.
Wow.
I mean, Pure Leaf Tea, Rockstar Energy. Gosh, I mean, it's just Spitz, the sunflower seeds, Soda Stream, Sobe. I mean, the Sabra, which is the hummus, I believe. I mean, they have so many different products that I can see what they have. Gatorade, obviously, Fritos, Cheetos, Captain Crunch. I didn't even know they were in cereal. Jeez,
wow. That's not a good place to be though.
Bubbly, which is the Michael Bublé used to do that commercial there. I mean, they have stuff all over the place. I think what Elliot is saying is like, you guys need to like focus on something and be good at it. Where right now they're just throwing everything at the wall and hey, we got some market share here. And I can see where there's likely opportunities for improved efficiency.
And I think they had Propel as well, and that was one that I liked. But I think you're right. You got so many different brands, you lose focus. And and with, again, the diet drugs.
Propel, they have Propel.
With the diet drugs, it's just kind of like people are not going to be eating as many chips and
that's
Fritos.
the thing I'm not sure of is how much of snacks is their company versus soda. But even with GLP-1s, I don't think people drink as much soda. I could be wrong on that, but I'm not sure.
If you're full all the time, you're not going to want a carbonated Pepsi.
Yeah.
So, and Pepsi, I don't drink Pepsi. I don't really drink much soda at all. But, I mean, I'm glad to see they got other things. But I don't know. I want to kind of like it. That's why, I saw what's going on with Elliott Management, what's he seeing. It has had a nice rebound, I think, over the last month or two. But it's just... I'm just uncertain right now with the diet drugs. And I think someday there'll be a problem with those. But for now...
and especially given the valuations around 17 times earnings, it's like with the potential headwinds, right. I would want this at a far better value than 17 times earnings. And it's not like PepsiCo is going to grow earnings at 10% a year. So, I mean, you're overpaying, I think, still for this business with a lot of potential problems.
All right. Well, let's switch over to another company, DocuSign. DOCU is their symbol. They're in the software application industry. Not much short on the float, about 4.1%. Institutional ownership, about 89.1%. Unfortunately, this was a big player back during the pandemic, but they still have a pandemic-type PE, about 60.9, below the industry, 63.8, but still very high. Price to sales, 5.5 versus 6.6. That is good. Price to book value, 8.1 versus 6.8. Price to cash flow, 16.3 versus 30.4. That is a positive. And even the PEG ratio looks good at 0.8 versus 60. But the problem they're having is that their earnings over the last year, well, gosh, are down 72%. The industry is up 13.2%. Sales for DocuSign were up 8.3%. The industry is only up 5.4%. And the 5-year estimated growth on the earnings from the analysts, well, that's pretty good at 26% versus 1.1%. So that looks pretty positive. Unfortunately, they do not pay a dividend. Let's take a look at the balance sheet here. Current ratio a little bit low, 0.7 versus 1.7. We'd like to see it a little bit higher. However, the debt is very low for the company, only 0.1 versus 0.5. Net profit margin, it's okay at 9.1 versus 12.6. And return on equity, 14.1 versus 19.1. Cash flow, free cash flow, not that great, about $936 million versus $2.9 billion. So not great start here. What do you got over there, Chase, on the going forward?
Yeah, so current price here for DocuSign, again, their ticker symbol is DOCU. It's $80.19. And, I mean, this stock's been all over the place. 52-week low here, $55.14, and the high, $107.86. And I was kind of surprised because I saw the one-year return was up like 42%. I was like, wow, this thing must be doing pretty good year to date. Nope, it's actually down 11%. So, like I said, it's kind of had a weird trajectory, and I don't want to say it's weird, but it's bad. I mean, the 5-year return down 60%, and the all-time high for DocuSign, again, you mentioned it was a COVID darling. Gosh, trying to find that here. The all-time high was $310 was the all-time closing price.
Wow.
Actually, the all-time high, not the all-time close, was $314.76. Yeah. But going forward for DocuSign, let's see, we go out here to January 2027. I see estimated earnings per share of $4.03. Gives us a target sell price of $66.90. Unfortunately, it's still expensive, trading at nearly 20 times those future earnings. I was hoping we might find a value here, but it doesn't look that way.
It's not looking away at all. And unfortunately, there's a closing bell, so we're going to wrap it up. So thank you for listening to the Smart Investing Show. It is for information purpose only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to give myself a call, Brent Wilsey or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, smartinvesting2000.com. A lot of great information there. Sign up for the free newsletter. It goes out every Friday by email at 5 o'clock. So thanks for listening. We'll be back next week right here on the Smart Investing Show.